Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to take a look at some news that just came out on one of our favorite stocks, BFT. And then we're also going to take a look at a new stock that I just added to the portfolio yesterday that I think has a lot of room to grow and a really nice price target on it. So let's not waste any time. Let's jump right in. Alright guys, before we get started today, subscribe to the channel, hit that bell notification so you can stay up to date. I try to post new videos every day with like penny stocks, growth stocks, value stocks, anything that I think can help us grow our portfolios and become better investors. There's a link down in the description to my Patreon account. Come join the family over there. I did the first 100 patrons for just $1. It's filling up quick. I think we've got about 70 spots left. If you want to come help us join, grow it, come join us over there. We just hit 500 subscribers on YouTube. I do want to say thank you guys so much. You have no idea how much it means to me. Your support is everything, and I love you from the bottom of my heart. But when you do come to the Patreon, you'll get access to the private Discord where we talk stocks. You'll get links to 4 different portfolios so you can see exactly what I invest into. And then anytime I buy or sell a stock up to the second I do it, anytime I enter a swing trade or a crypto trade, I send that out so you can follow along. I'm also setting up another channel in the Discord with all of our plays and our price targets for short and long term. And I'm trying to develop a grading system so I can grade them depending on market sentiment or kind of how things are going. So if you want to check that out, if you want to help us grow the community and be part of the family, come join us. We would love to have you. But that's it. Let's jump in. Let's not waste any more time. Okay, guys, so the first thing we're going to look at today is the BFT article. We'll cover that real quick, take a look at the chart, and then jump into the penny stock, which is LOTZ, LOTZ is the ticker on that. I do want to say a couple things here before we do jump in. Guys, this market has been giving us a beating lately. It's been really brutal, and we just hit yesterday the 1-year mark for honestly one of history's probably greatest stock market crash recovery bull runs since since COVID, been up over like 80%. Now, typically bull runs do go on for, more than, the first year. They typically go on for 2, 3, 4 years sometimes. The second year is typically, less than the first year as far as gains, and it's usually pretty choppy. I do think the market will settle down. I think this volatility is, not going to last forever. But one thing I do want to say, guys, I hear, people all the time like, oh, I'm cost average down out. Like if you've got these high conviction stocks and they're dropping and you want to cost average down, don't just cost average. Like if a stock's sitting at 90 and it goes to 80, don't buy more and then buy more at 70 and then 60 and then 50. What you want to do is you want to cost average down with intent. Like you want to cost average down when a stock gets to a point where it's going to drastically change your cost basis. You don't want to just buy down every time it dips a little bit, because then you'll run out of money and you won't have enough to really, make a difference. If you've got a high conviction play like NEO, where before we started into this, it was around the $50, $60 mark, you don't want to buy back in at 55 and then 48 and then 42. You want to wait until it hits that point where it's going to, if your cost basis is 50, you want to wait until it gets down to 30, 25, so that you can cut your cost basis in half. Now, that's always going to be different where you cost average down, but what I'm getting at is don't just buy every single dip you see. Wait and buy dips with intent and purpose to cut your cost basis. That is the goal of cost averaging down, because you plan on holding it for the long term and you want to get your cost down as low as possible. So that's all I wanted to say. Let's jump right in. Okay, guys, so the first thing we're going to look at today is this article that just came out on BFT Paysafe. You guys know that this is one of my favorite stocks. I think it's going to absolutely kill it over the next few years. They just partnered with Coinbase. If we look here, it looks like it says, Paysafe was up 3.7% in pre-market trading after they announced a partnership with Coinbase. Paysafe said in a statement that its Skrill digital wallet has expanded its cryptocurrency offerings to the U.S. in partnership with Coinbase. The deal will see Coinbase providing a new cryptocurrency white label solution to Skrill, which is very, very cool. Guys, this is big. Like, Coinbase is a massive platform with a ton of users. From what I can tell here, it looks like they weren't currently offering in their Skrill wallet, cryptocurrency in the US. And so if they're doing that now, that's going to bring them a lot more revenue, a lot more exposure. They already work with big companies like DraftKings and Twitch and Amazon and all these, different companies. But this puts the icing on the cake. I love hearing stuff like this. I think the price point that BFT's at right now, if we take a look, sitting around that $15 mark, is a very nice looking price. You can see here, came out, a merger announcement, boom, big pop up, around the $16, $17 mark, kind of sold off a little bit, boom, popped clear up and almost hit $20 at $19.57 at the high. Now, the reason why I love this stock is because during this big market correction that we've had the last few weeks, it didn't get beat down nearly as bad as a lot of the other growth stocks we've had. We got stocks that are down 30, 40, 50% on some of these big high growth stocks, where this one is down 24%, 25%, depending on where you're looking at. But to get back up to the previous high, you've got 32% upside, which is huge. I do think that over the course of the next year, 2 years, you will see it reach that high and do a lot better, if not double it. My price target for anywhere from 12 to 24 months is $40 to $44. I have people, tell me that's way too low, but I would way rather tell you 40 and it hits 60 than tell you 60 and it hits 40. If we take a look at the chart, like I said, guys, you can see, ran up, kind of has been consolidating, on a little bit of a downtrend. This right here, you'll probably run into a little bit of resistance right here. It looks like it is kind of coming up and trying to break through the moving averages, the 50 and the 20-day. You do have a little bit of support down here around the 1380. That would be your optimal entry if you're not already in this stock, but if you plan on holding it for the long term, I would watch it, kind of see what it's doing, see if you can get it to close up above the moving average. But again, down here at the $14, $15, $16 mark, great entry. I think you will do just fine if you're patient. If you're looking to hold it and trade it over the course of the next few weeks, then yeah, wait for it to pull back a little bit, try to get in a little bit lower. But I do think you have some nice support down in this area down here. Like I've said before, you can use gaps as support and resistance. They work really well. I think you will run into some resistance up here around the probably the $16.30 to $17 range, those whole numbers. Then again up here, but I think again, once we kind of get out of this market correction, the stock will do very well. So check it out. If you don't already own it, definitely go look into it. Next one we're going to take a look at today is LOTZ. This is the ticker symbol LOTZ. I've been watching this for a little over a month now. This actually was a SPAC. They merged, the ticker symbol changed, and now they are trading under LOTZ. These guys are bringing a very, very cool approach to the car dealership, car manufacturer type industry. Very disruptive right now. So what these guys do is they are a car dealership, but they are an asset-light car dealership. What I mean by that, say a traditional car dealership, say I open a car dealership and I want to be a Chevy dealership or even a used car dealership. Regardless, you've got to go out there and you've got to get inventory. So if you're a used car dealership, you got to go buy cars at auction, you got to go find them on the streets or whatever. And in order to hold a lot of cars and have a large selection, you've got to bring on, in some instances, millions of dollars of inventory and have that overhanging. Now, a lot of these big dealerships, say they've got the 2020 models in, they want to bring 2021 models or 2022 models, and they've still got these other cars, they've got to get rid of them. So they've got two options: take them to the auction and lose their their behind on them, or wholesale them out to a somebody that'll buy them all at once and then tidy them up and then resell them, which again, they lose on it typically. And so one thing, here's a tip if you're ever buying a car. When you go to a dealership, they can only keep most of those cars on the lot for so many days before they send them to auction, because they've got to turn over, they've got to get money back. And so if you're on a lot and there's a car that's a few years old or whatever, and you see that it's been on the lot for 60 days, ask them. It's usually like 60 days, I think 65 days or something like that before they send it to auction. That's how I did with my last car. I said, hey, this car's been here for almost 60 days. Like, I know you're getting ready to take it to auction. Give me the price I want. And they'll usually work with you. So that's a tip there. Okay, so what these guys do, why it's so cool. They go set up these hubs, these dealerships. They've also got a really good e-commerce platform, so they're selling online as well. But they will go out and they will, partner up with dealerships or banks or rental car companies or leasing agencies or whatever. So like, for example, say a bank, goes and repos all these cars and they've got these cars. Well, they need to offload them and they need to do it quickly to get their money back. So they'll go to these guys, they'll partner up, they'll give them the car. These guys will essentially tidy them up for a flat fee, sell them, and then take their cut. So they don't have to leverage that inventory. So it's so scalable because they can just take it, and they've nailed it down over the course of the last 9 years. So they can go open up locations all across the country. If they've got partnerships with big dealerships, car companies, rental companies, then most of the time they have locations in other areas of the country. And so they can, usually open a location and then just get that franchise that they're previously partnered with out there. What I'm getting at here is they can get a lot of inventory, big selection without having to buy them outright. It's like a consignment, retail type, strategy that nobody's really doing right now. They also work with like, say I'm a general consumer, I want to sell my car. Instead of going in and taking it in and getting trade-in and losing a ton of money, they will sell it for me, which sometimes doesn't always work out. That's how they started their model a few years back. But typically, if I want to get a new car, I can't afford to float my car to someone for 30 days and then go buy another car. Usually, people have to sell their car, use that money for a down payment. That's why they got to do trade-in. But, oh my gosh. But going after the dealerships and the fleet management companies, they don't have to do that. They want to get rid of their cars as fast as possible, and so it makes perfect sense. Okay, so let me give you a couple numbers here. This is their website. You can read a couple of things on here. Our consignment model reduces overhead and inventory costs, so buyers pay below traditional dealer prices. So it helps the buyer and the seller. Couple of things. So from 2020 to 2023, they project a compounded annual growth rate of 45%, selling 80,000 cars a year by 2023. They usually, I think they make around $1,800 per car. We'll look at the investor presentation, but their customer acquisition cost is super low. So when I say they're disrupting, they're really going out there and, the auction houses, those types of people are really kind of taking the butt end of this because they came up with a bigger and better way. If you look at it like this, Uber didn't put taxi, companies out of business. Amazon didn't put, restaurants out or retail stores out of business. Poor service and lack of innovation did. These guys are giving better service, more innovation. That's why they're taking it over. Okay, so first thing we want to look at. So I want to kind of give you an idea, like if I was a dealership and I was to take my Jeep Renegade with 50,000 miles to the auction, I would probably get around 10 grand for it, a little under 10 grand. If I was to take it to these guys, they would sell it for $15,500 and I would make $3,816 more than taking it to the auction. So you can see why it incentivizes these dealerships, these banks, these car companies to use them, give them their inventory and consign it over there. Their average is $1,000 more than retail remarketing, which again, as a dealership, if you've got a ton of different cars, that adds up to a lot more money. This is kind of their platform for buyers. So the other thing is the car industry, selling cars online as the e-commerce, is set to grow at like 70 times in the next 2 years. So that's huge growth there. These guys are actually planning on opening 3 to 4 new hubs per quarter. That is huge because it's easy to open. It's very, you know, they can duplicate the strategy, and it's low cost to do it because they don't have to go and flow inventory. Like I said, it's very asset light. So you can see here, if you wanted to buy a car, you can jump on, browse the cars, get the pricing, set up a test drive, get a warranty, financing, and then check out. So very innovative and easy. This right here kind of shows you to their competitors, their gross profit per unit. Now this is cool stuff. So you can see they've got the second highest gross profit per car sold out of Caravan, Shift, and Vroom, but they've got the lowest customer acquisition cost. So it costs them a fraction of what it's costing these guys to get a customer, to get a sale, but they're making the second most amount, which is phenomenal. Their contribution margin is way more than everybody else, and then their investment at risk inventory is next to nothing because of the asset light business. This right here is showing the revenue growth, some bullet points on, you know, again, innovate and expand technology leadership. But you can see here, now this presentation was made back in 2020 of October, so it might be a little dated. I will link this below so you can go check it out. But you can see here, the revenue estimates for 2020 was 110 million. I actually think they did a little bit more than that. And then they're gonna jump that up to 356 million in 2021. Almost reach $1 billion in 2022 at 945 million, and jump that all the way up to either in between 1.5 and 1.7 billion in 2023. Guys, that's like 13 times growth in 3 years. And to think about it, like I was saying before, they've really only got to sell around 80,000 cars a year by 2023 to hit those metrics, which is like 1% of the total, you know, used car industry. So I think that's honestly even a little conservative. And I think there's something in here that says that. Let's look. Okay. So right here. So you can see here, like I said, it's an 841 billion total addressable market. There's 12 million used vehicles annually sold through auctions. That's a lot. They're starting with very low penetration at 1%. 0.1% today, and estimated to get 1% estimated by 2025. That's big. That's huge. They're like you know, jumping 1,000% there almost. So you can see here, in 2020 they were estimating to sell just over 6,000 vehicles. Triple that to 2021 to almost 20,000 vehicles, and then double it again to you know, 2022 to 49,000 vehicles, and then almost double it again in 2023 to 80,000 vehicles. Again, right here, opening 3 new hubs per quarter, with the first several hubs identified by experienced real estate teams, so they're picking very good locations. They can be operational in 90 days. They can get a location and be fully operational in 90 days. That's speed to market if I've ever seen one. Again, can be operated with just 750,000, which is great. Supply of consignment inventory to hubs ramp up rapidly, starting within 30 days of opening. So they ramp up that inventory really quickly. Again, here's your revenue, and then the gross profit. Gross profit is looking really nice as well at 164% compounded annual growth rate from 2020 to 2023. Okay. There is one or two more things I wanted to show you right here. So this is kind of their revenue per, you know, sales volume at their current hubs and then their existing hubs. What's cool here is it says assumed sales of 35% of hub inventory compared to more than 50% at existing hubs each month. So like I was saying, they're almost speaking conservatively, it seems like, with these numbers, because the current hubs they have are already doing better than what they're estimating. So very cool there. Last thing I wanted to show you guys is this right here, their footprint. As of right now, you can see on the East Coast is where they're primarily at. That's where all their locations are. But they can do everything across the country because they have their e-commerce technology, their e-commerce platform. So as of right now, in 2020 or 2019, they had 0.2% of the penetration of used vehicle market. They are projecting to grow it 8 times by 2025. Or 2024, and have 1.5% penetration. You can kind of see here the existing, you know, locations or hubs and where they plan on putting them. Again, they can reach the entire country. This is a very scalable business. You know, they could have multiple hubs, you know, in the bigger states. Like, I could see them, you know, doing very, very well with these as they scale, because they've perfected this business model, and it's easy to do. They assume an average new hub with inventory of 390. New hub sells 1,600 vehicles in year one, which is 35% sell-through, growing that to 2,600 vehicles in 5 years at a 56% sell-through. That is huge, guys. By comparison, existing hubs on average reported sell-through of 42% in the last 6 months and 56% when mature in the first 6 months, excuse me. Average retail price growth of 3.7% per year, driven primarily by mix, compared with 11% growth in the past 12 months. Guys, they are very, very cool company. They've got a very cool model. They are disrupting this industry, and I think they will do very, very well. With COVID and everything, you know, as everything starts to grow, and as we've you know, expand technology, people are you know, buying cars online. They're you know, they don't want to go into dealerships and deal with salesmen. You know, they don't, dealerships don't want to have to take their cars to auction. So if you can get in and they can innovate, they can keep their costs down, they can expand, they can grow. I think that their growth rates are even a little bit conservative, and I also think the price target is looking a little bit conservative. Let's take a look at the chart. So you can see here, came out, you know, with the SPAC around the $10 mark, came out, boom, popped clear up and hit a high of around $13 at $12.90, and then over the course of the last few weeks got absolutely beat down. Now this mark right here at $7.65 is not a bad price. You know, they are down almost 2% today. You can see they probably have a little bit of support right here around the, you know, $7 range. Now, I think if you plan on holding this for a year, that's a great price. You know, you could watch it for the next few days and see if, you know, it'll pull back even more. But I think that, you know, if you take a look here, it is on a pretty steady downtrend, you know, but at the end of the day, everything is right now. The price target that an analyst that I just saw put on it was $22. You know, depending on how the market goes over the next few months, 12 months, that was by the end of the year they put that price target on it. So you're looking at, what, tripling your money, you know, a little bit more than that within the next, what, 9-10 months. And so, guys, I really like this. I just added it. If it continues to pull back, I will add more shares. So go check this out. My price target on it was upwards of around $25 within by the end of 2021, but we'll just have to kind of see how it goes. The cool thing is once they hit that mark, it's not like their growth is going to stop. I could see them continuing to grow at this rate for years. You know, a lot of companies, they grow at, you know, big compounded annual growth rates for the first year or two, and then they plateau and fall off, where with this business model, I could see them continuously growing it at a rate like that. So that's it for today, guys. I wanted to keep the video as short as possible. I know I get long-winded. Very cool stock. I'm very bullish on it. You know, if you have any questions, put it down in the comments. You know, if you got any tickers you want me to cover, let me know. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. You know, come join us at the Patreon. Help us grow the community. We would love to have you. You know, to all my current patrons, I love you more than anything. And I'll see you guys in the next one. Peace.